Okay, we are recording now. So thank you everyone for taking the time to join me here. Uh, and it's great to virtually be here at the University of Michigan. And fortunately for me, I was able to visit a couple weeks ago at your stock picking competition, and it was such a fantastic event. So I'm just honored to have been there, and my hat's off to everyone who worked on that. And hopefully you all were there. So for those who haven't met me, my name is Andrew Rosenblum, and I'm an investor based in San Diego at a firm called Bonsai Partners. To be honest, it's not much of a company, and it's just me. And I think that Louis the 14th said, "I am the state," and maybe I should have said that I am the company. But I'm really honored to speak with you all. And what's funny is I was sitting where you all are 10 years ago. So I was a part of Michigan Interactive Investments. I used to go into the Tazi Center all the time. And I think the Tazi Center has moved, so it may not be the exact same location that it used to be in, but a huge part of my undergraduate experience was being in the Tazi Center. When I wasn't sleeping in class or with friends, I was in the Tazi Center, ripping through annual reports, learning about companies, talking with people about what makes for a good investment. So it was a huge part of my learning at Michigan. So it's just fun for me to be back. And the point of what I'm trying to do and get across to all of you today is to share some of the things that I've learned since I graduated, having gone through the investment world a little bit and the business world. Because looking back, I realized there's a lot of stuff I wish I'd known. It would have saved me a lot of headaches and heartaches. And if I can share anything of value, I think this will be a win. My disclaimer to you is I realize that wisdom, if I have any, is easy to collect for yourself, but very hard to share. So it's possible that what I'm saying will ring hollow unless you experience it yourself. But if I cover enough ground, maybe you'll be able to take away something that's valuable. So the name of what this talk is, as I thought of it, is what I wish I knew about investing. So for those of you who are thinking about a career in investing, investment management, I hope that this is helpful. And for those of you who are more broadly going to the business, maybe there'll be some applicable learnings as well. So that's what I intend to cover. I imagine this will take maybe 45 minutes to get through what I've thought is important, and then we can take questions at the end. I'm happy to answer anything you have. So let me just start with an anecdote. I wish I could shake everybody's hands and say hello myself, but I remember a great professor I had when I was at Michigan. His name was Ralph Williams. He was very well known at the time, and he was an English professor who could fill the biggest lecture rooms on campus. And before class, every single class, he would go through the entire hall and shake everyone's hand. And he would say, "It's wonderful to see you. Thank you for coming." So I wish I could do that right now and say thank you for being here, but this will have to suffice. And one thing he did that was really effective, I thought, was he did something that he called the rubrics. And all that was a quick overview of the topics that he was going to cover during the day. So I'm going to give you what I call the rubrics for this talk. So they're kind of like little bullet points and subheaders. And the hope is that when I get to those points, a switch will flip and you'll say, "Oh, okay, that's where we are in this." So here they are. So point number 1, seek efficient markets. Point number 2, here today, gone tomorrow. Point number 3, stay flexible. Point number 4, learn, don't copy. Point number 5, we're still learning. Point number 6, investing is personal. Point 7, know your game. Point 8, seek simplicity, not complexity. Point 9, intellectual honesty over intellect. And the last point, point 10, tremendous change is upon us. Okay, so I'm going to dive right in. This is not going to be, a war story. I shorted this stock or I went long this stock and here's my view. If you want, I can go through some of that stuff in Q&A. and like kind of like the more mechanical elements. But for now, these takeaways are big, broad lessons that hopefully you find valuable. So let me start at the top. So seek inefficient markets is where we're going to start. One of the things that is a cornerstone of what I'm doing now, actually, let me back up and let me just tell you really quickly my background, because I didn't explain that at all. So I graduated in Michigan in 2010. I went to a hedge fund called Matrix Capital immediately after graduating. A Michigan alum took pity on me and hired me, and I spent 5+ years there. I did a lot of short selling. Matrix was a fabulous performer. We were one of the top funds for a number of years. And when I left, I went to build a biotech company at a company called Adaptive Biotech. We did cancer immunotherapies. I did that for a year. And then I pivoted back to investing and started Bonsai around a year ago. So I've been getting that off the ground over the past year. So I have some long-short equity experience that I can share, as well as some startup experience. So let me go back to the talk. Sorry to jump around. So the first point, and I think it's really important to explain because it's a part of the ethos of what I'm doing now, seek inefficient markets. My view is that today there's a war between active management and passive management. The passive indexes versus the fund managers who select securities for their clients. And my view is that active management only works in inefficient markets. Now, that probably sounds obvious, but if you just take a step back and think about it, most money today is invested in efficient securities, efficiently priced, fully priced assets. If you pull up the 13F filing for really any large fund, you'll see the same set of names that you probably know. They probably belong in the S&P 500. So what I'm trying to get across is this is not the usual course. And so let me tell you why I believe this. Active management is really expensive. If you're an investor and you're going into the financial markets and you want to put your money to work, paying someone to manage your money costs a lot. It's not just the couple percent you pay every year for the privilege, but it's all the money that you would have had if you were able to compound it over time. So if you pay a couple percent, that compound interest on that capital is gone. And so active management is really expensive, and you need to earn in excess of market returns to be able to pay for it. And you're not going to be able to find that in really efficient markets. These are the biggest markets out there. And when I say markets, I mean individual companies. The stock market, it's called a market, but it's thousands of markets. So there are inefficient markets in it and efficient markets in it. And you want to find the ones that are really inefficient. So this will blow your mind. If you go and you look at something called SPIVA, it's part of S&P. SPIVA does a study annually that shows how active managers like a mutual fund and others that are have readily available public data stack up against their passive benchmarks. So like the small cap value funds or the large cap growth funds, they'll compare it to their relevant benchmark, and they'll show you how they've done over a long period of time. And you'll be amazed to know that 95% of those active managers don't beat the benchmark over 15 years. And the longer the time horizon that you go out, the smaller the percent that beat the market. And you'd think that it would be more like a 50-50 coin toss. It wouldn't be close to 100% of these managers that fail to beat the market. And keep in mind, these aren't hedge funds. These are more like mutual funds and other long only big, the BlackRocks of the world, for example. But it should really pause and make you think, is this the right way that I should be going down? So let me tell you a story. Earlier this year, I went to the Daily Journal annual meeting, which is kind of this, Charlie Munger, Warren Buffett, great event. I highly recommend people go to it. It's in Los Angeles. And in the middle of the meeting, there's a guy named Peter Kaufman, who is the CEO of a company called Glen Eyre. And he's like a big fan of Charlie Munger's, and he wrote this book on Charlie Munger. And he did this 5-minute awesome interjection where he talked about what he looks for when he hires a manager, when he hires an investor to work for him. And one thing he said was, and he said it's true in his business, where there's mystery, there's margin. Where there's mystery, there's margin. So if you're operating in an efficient space, what kind of margin do you think you're going to get? If you're buying the same securities as everyone else at 30, 40 times earnings, what type of returns do you think you're going to get? And he asks this of his managers when he tries to find someone to work with. And what I would, here's another story. So another investor I really like is Carson Block at Muddy Waters Research. I don't know if you guys look at what he does, short selling in China. I think he had said that the reason he calls it muddy waters is there's a Chinese proverb that says you can't catch fish in clear water. If a fish was in clear water, someone would have grabbed it out already. And so it's by going in those inefficient spaces that are hard to reach, that people don't get, that you actually solve the problems worth solving. If you follow in someone else's footsteps, if you follow, the easy things, you won't be able to achieve very much. So investing is the first derivative of business. And so what I mean by something being inefficient or efficient, it's all about price. If you're investing in public companies, you need to be a great company analyst, not a stock analyst. If you're focused on stock prices instead of how a company is doing, you're missing the point entirely. The point on price is more about telling you what you need to be able to get right in order to make money. So when I say investing is the first derivative of business, if you find a great business and everyone knows it, it doesn't mean anything. It's not enough to be right in this business. You have to be right, and you have to have not everyone agree with you. Because if everyone agrees with you and you're right, it just doesn't matter. So you need to find those inefficient spaces that people just don't know if you're right or not, because that's where the real opportunity lies. Here today, gone tomorrow. So these inefficient spaces that I talk about, here's the hard part. It's constantly changing. So when you find this great inefficient market for yourself, unfortunately, they go away. And the reason for that is markets like this, they go in cycles. You find an inefficient space, you can earn outside returns in that inefficient space, but what happens is others realize that you found it. And what that does is it introduces new competition in what you're doing in the financial markets, and it makes prices go up and generates lower returns. So there's kind of this creation destruction cycle in investing where even if you find something that's interesting, it may not stick around for very long. And that's the tough and frustrating part. So let's look at some of the best investors. We can look back and see if this is true. So is everyone familiar with Ben Graham, Intelligent Investor, Securities Analysis? Some nods. One of the legendary titles, Ben Graham hired Warren Buffett at his company. His claim to fame was he invested in what were called cigar butts or net nets. These were businesses that were not doing too well in like the 40s and 50s, but they were so cheap that you could buy them for less than the liquidation value. So if you bought, a company that if you liquidated all the assets and paid off all the creditors, it's worth $100, you could probably buy them for 50. And so he was just pocketing this change. So either the businesses did well or they liquidated and he made money. He did extremely well for decades. But what happened was that opportunity went away. You cannot do net investing anymore. It's gone. Computers can just calculate the book value and make some assumptions on what it's worth, and it's so formulaic and easy. Has anybody heard of "You Can Be a Stock Market Genius" by Joel Greenblatt? Joel Greenblatt is the parent of special situations investing. He had amazing returns, and in his strategy, his inefficient market that he went into was spin outs and restructurings and workouts and bankruptcies. And this was a place that very few people were willing to go. It was complicated. It was hard to know what these spin-off assets were worth because they didn't have financial statements. And he just made a ton of money, but he also gained a ton of attention for the strategy. And today, it's not that you can't do special situations investing. It's that the opportunity set is much smaller and it's much more efficient. And so something that I learned was the things that worked over the past 20, 30 years, by definition, likely won't work in the next 20 years. And this is kind of like, it's Econ 101. There's not many barriers to entry in public equity investing. Anybody else can copy your strategy if they know about it. So you need to keep that in mind, and that really segues well into the third point, which is stay flexible. The best investors evolve and change. I think the best example of this is Warren Buffett. So, Buffett started out doing the Graham Dodd approach. I was talking about Ben Graham before. Buffett worked for Ben Graham. He was buying nets. That's what he liked to do. But he changed over time. He started buying companies for their growth. He went out of public markets. He bought a company. He bought Berkshire Hathaway. He started managing the cash flows of that business. He became a private equity investor. I mean, heck, he even looked at the latest Uber round, participating in it. So if you think that guy is not changing, the greatest investor of all time, wrong. He's constantly been evolving because he realizes that what was inefficient is constantly evolving. And what's really frustrating about this is if you're running money, this actually runs opposite of what most investors out there want. Most of them want to put you in a box and label you and say, you're a growth investor, or you're a value investor, or you're a special situations investor. You do this one thing really well. It's an algorithm over and over again. You generate great returns. But that's actually not how great investors operate. They have a core set of values that they adhere to, but they're willing to change as the market around them changes as well. And unfortunately, a lot of investors will call it, style drift. And unfortunately, it's all the same. It's all you're trying to find great investments. Point 4, learn, don't copy. I really, really suggest that you learn from the best investors, but you don't copy them. I personally love that you look at the Berkshire Hathaway annual meeting. I'm plugging on Buffett right now, so he's just a case study. But I love that people line up for that meeting every year, but I see way too many of them who blindly copy him. They are part of that Econ 101 hamster wheel of people who see what works and then they just rush in and copy what works. And then the returns just plummet. That's kind of what's going on right now. But at the same time, I want to be very clear. I want everyone in this room to read the Buffett letters, his annual shareholder letters, because it's an amazing learning tool if you're interested in being an investor. I'm just saying you shouldn't copy exactly what he did. So, let's imagine that you're in a completely dark room. You're blind. You can't see. That's what investing is. No one knows precisely what works. It has no clear defined path. There are no rules. Maybe there are some rules, but nothing always works. You just want to get out of that room. You want to find the light. You'll stumble around, you'll hit something sharp, and maybe you'll bump into another person who, lends their hand to you and says, look, follow me, I'll show you the way out. And it's really tempting to want to copy somebody else who's offering you the easy way out. Unfortunately, you won't find what works unless you figure it out yourself. That's the only way to find the exit out of that dark room. Just to put it another way, if you're a physicist, you're going to learn about what Einstein or Isaac Newton did. It just makes sense. Learn about how they did it and what they found out. But you won't find many physicists who read about Isaac Newton and that story of Isaac Newton sitting underneath an apple tree and it hits him on the head and he learns about gravity. You won't find many physicists who say, well, now I need to sit underneath an apple tree to get my next revelation. Like that's not going to help you find the next physics discovery, unfortunately. And so what I'm trying to say to you is learn from these great investors and allow them to help you figure out what's next. Learn the universal rules, but don't blindly copy them. Point 5, we're still learning. So we're still learning what investing is. It's a relatively new discipline, if you can believe it. It probably, as a profession, has only existed for a little over 100 years. I don't know precise dates. But the unique quality to investing is that the cycle times are incredibly long. It probably takes 20 to 30 years to know and evaluate if a certain investor or strategy works. You can just get caught in a bull market and look like a genius for 10 years, but it really takes a long time. So if you look at, those 20 to 30 year periods, we only have, 4 to 5 discrete periods of time to go back and put your archaeologist hat on and say, what works and what doesn't. So it's very tempting to think in absolute terms that we know what works and what doesn't, we're still learning about investing. So that segues into point 6, which is investing is personal. You and I, we can look at the exact same company and come to different conclusions, and that's okay. There are no objective answers. And I probably don't know very much about any of you in the room, but I can promise you one thing. No one is better at being you than you are. That's probably the single thing that you can say that's your superpower definitively. I'm sure there's other amazing things that you can do, but that's your superpower, and you need to figure out what it is that you're trying to do and how you can use your superpower to be able to be the best investor that you can. There are, tons of hot investment spaces you can go into. Like I probably, I could go into blockchain, I could go into private equity, venture capital. I don't know if you guys know this, but the public markets have really taken a beating in terms of people's perception. And I could go into things that have much, it's a much easier story to tell, but it's suited really well to my temperament. And I would implore you to figure out what are the things that you're really fascinated by that you're able to do uniquely well, and go for it. One of my favorite quotes comes from Joseph Campbell, who was a professor of mythology, and I think he's since passed away, but he said that the privilege of a lifetime is being who you are. So don't ever forget that, and use that to your advantage when you enter this field, if you do. Point 7, know your game. So we spend a ton of time focused on winning the game at hand, and we often forget to ask, should I be playing this game at all? What game should I be playing? You need to think about the first principles of what you do all the time and understand what matters in the system that you're operating in. So when I worked at Matrix, I spent most of my time as a short seller. It was an open field there was maybe 10 of us investors at the fund. There was no one really doing it, and I figured I could really make a name for myself. It was fun. I got to hunt down frauds and companies that were being disrupted by technology. I got to do all this some fun work, but I never stopped to think, should I be doing this? I was just so focused on winning the game that I forgot to ask myself, was it worth doing at all? And it was only after I left that I realized that short selling doesn't really accomplish what I'm trying to do. It may accomplish what you want to do, but not for me. And frankly, there are very few people who actually know what they're trying to do. Remember, investing is stumbling around in the dark. You need to figure out what it means to you. And for me, what I view investing as is it's obtaining compound interest. Anybody who's looked at a compound interest table knows that you can get some ridiculous outcomes if you just can obtain, a decent rate of return. It doesn't even have to be, 20+%. If you earn 15% for 20 years, I think it's like 20x your money. And so I want that. I think that's a lot easier than trading in and out of stocks or, going long and going short and playing around. I just want to find the few great investments that I can own for a very long period of time that'll compound my capital really well. And short selling doesn't do that at all. In fact, it actually shrinks your profits over time. It reverse compounds. So if you have a $100 investment and it makes 10%, you made $10. And then if you make another 10% on top of that, you made $11. The earnings compound. But the opposite is true if you sell short a stock. So if you have a $100 short position and you make 10%, you made $10. And then the second 10%, you made $9. It gets smaller and smaller and smaller. In fact, you're paying compound interest instead of earning it. You run all the risk of short selling with unlimited loss and limited gain. So I would implore you to know which game you should be playing and understand what you are playing. Point 8, seek simplicity, not complexity. So one of the most important lessons I learned in investing and in life really is figuring out the difference between simple and complex systems. So for this audience, I imagine you guys get this. There's a big difference between micro and macro econ. In my opinion, I think it's a lot easier to know the micro than the macro. It's a lot easier to know what a company's going to do than an entire economy. And the reason for that is an economy has so many variables that are interconnected. it's hard to know what chain reactions are going to happen when something happens in an economy, but in a business, you can probably look at their products and the competition and the customers, and you can probably come up with a reasonable guess, but that's hard enough. So in 2016, I left the hedge fund industry and I went to start a biotech company. I wanted to do something meaningful. I wanted to build this company that had this amazing technology that was trying to cure cancer. And all the time, now that I'm back in investing, people ask me, do I specialize in biotech? And they seem surprised when I tell them that I don't, and I don't intend on investing in biotech at all. And there's a moment in time that really crystallized this lesson for me. I was talking with, we were making these amazing T cells that would attack cancer. And I had a conversation with our head of science, and I asked him, what are the odds you think this works? And he looked at me and he said, Andrew, to be honest with you, we have no idea. No one ever does in this field. And it just blew my mind that, the head of our scientific team told me that, but our investors were, we had raised a ton of money. Our investors thought they knew the answer. And so it really made me think, if the head of our science doesn't know, how could our investors, how could they make good decisions in this field? Here's just to hammer the point home. I don't know if you guys know the clinical trial process, but before a drug goes into any human, it's tested in in a petri dish with human cells in it, or it's tested in, a mouse or other animal models to see if it works. And if it works, then they test it in humans. What they found is, of all those trials that go into humans, 94% of them fail. So it literally worked in human cells, and then you put it in humans, and it didn't work 94% of the time. The human body is a ridiculously complicated system. You want to stay away from these complicated systems where it's impossible to know the answer of the question that you're trying to solve. This is what you need to do when you're looking at an investment. You want to ask yourself, do I know the answer? Do I know what's gonna go right? Do I know what could go wrong? In this case, you have no idea. You're flying blind. And the kicker for this is, of the 6% that actually stay in, the 6% that remain in clinical trials, only 12% of that 6% get approved. So something like 0.8% of all drugs that go through all those preclinical tests get approved. Oh, and by the way, it costs hundreds of millions of dollars and a decade to do a single one. So it's a crazy proposition, and you have to ask yourself, is that something that you want to do? You want to seek, I personally want to seek simplicity. I want to seek things where I actually might know the answer. I think Da Vinci said simplicity is the ultimate sophistication, and I have to agree with him. So the last points, okay? Intellectual honesty over intellect. Now I've been, I'm not super old. I probably look like I'm a sophomore. I snuck into the student section during the game a few weeks ago, and no one knew. But a few investors, and the most obvious thing that I've seen, from the really successful ones, is that they're intellectually honest with themselves. I think that actually the least successful people that I've seen, the theme that I've noticed is it's often the smartest people. The people who have been told all their life how smart they are usually the ones who don't survive because they think that they're always right. Investing isn't about being smart, it's about being able to survive your own shortcomings, and we humans have tons of them. You need to be paranoid about what you're missing all the time. Paranoid that you're tricking yourself, paranoid that you're just plain wrong. You need to do that all the time. Intellectual honesty is what matters way more than being really smart. So I think I hit those points. Yeah, so I guess the last thing I'd say on this point is, I highly recommend that everyone goes and they read the popular cognitive psychology books that everyone else has read. But to be honest, that's just table stakes. You need to read the Thinking Fast and Slow. You need to read the Nassim Taleb books. You need to read Cialdini. You need to understand all the things that make humans make poor decisions, because that's just table stakes. Otherwise, you're just fooling yourself. So you want to be as intellectually honest about your own abilities and your shortcomings, and that will help you survive. Survival is what matters in this business, not being really, really smart. Okay, so here's the last thing that I want to leave it to before I take your questions, if you have any. the industry is facing tremendous change right now. Like the hedge fund industry, you probably pull up the Wall Street Journal and every single day you're hearing about a big fund closing. And I want to provide a little context and my thoughts on it and potentially share my view on how I think the job prospects look and all of that. So it's, there's been a war that's waged between active and passive. And I would argue that 20 years ago, 25 years ago, hedge funds then are very similar to what venture capital is today. Venture capital is a super hot field right now. Everyone's making, tons of money. But 20 years ago, that was what a hedge fund looked like. Anyone could raise a fund, and everybody wanted to invest in them. And, you remember I said it takes 20 plus years to know whether or not a strategy works or not. We're kind of getting to that point where people feel that it hasn't been worth it. And I think that there's going to be more difficult change in this industry for a couple reasons. And I think there's some fundamental problems with the model as it exists today, not just for mutual funds, but for hedge funds. So on the hedge fund side, I personally think that there's two things that they really need to work on. So the first one is on the long side, going long certain investments. If you're a big fund, it really shrinks the universe of stocks that you can look at. You can only invest in the biggest companies if you're a multi-billion-dollar fund. And what are the big companies? They're, very profitable, consistently profitable, growing quickly. They're all really expensive, and it really limits your universe. So if you pull up, as I mentioned, any 13F of any hedge fund you probably know, I want you to look at it and say, what edge do they really have there? Remember, it's very expensive to be an active manager. So they need to be able to cover those costs. And the second part that's really tough is shorting is just incredibly hard. I've spent a lot of time shorting. I've had some success at it. I feel like you can do it, but I don't know of any multi-billion-dollar fund that has a multi-billion-dollar short book. Period. And if they do, it's like index trades, macro trades, or it's like a basket. It's not actually having a view. Shorting is incredibly hard to scale up, and it doesn't work at scale. And so it's very hard to generate those outsized returns that I was talking about to justify the costs. But let's just talk about the fees a little bit. So I don't know if you guys know this, but a typical hedge fund charges something like 2 and 20. So they charge 2% of all of their assets. So let's say they have $100. They make $2 every year, just for showing up. And then they make 20% of every dollar that they make in profit. So if they make 20%, they make 20% of 20, so 4. And that can make the manager really rich, but the money has to come from somewhere. When you charge really high fees, it comes out of your investors' returns. And unfortunately, the managers have gotten really rich over the last 20 plus years, and investors don't really have a lot to show for it. So let's just do a quick thought experiment and think about it, because I don't think a lot of people have thought about, what that means, 2 and 20. So the market, let's say it goes up 8% a year, on average. Let's make that assumption. If you take 2% off the top, it means that you need to clear at least 10%, returns, 2 plus 8, just to break even with the market. So you need to deliver 10% returns. And if you earn 20% of all of those returns, it means you need to get to roughly 4.5% all in above the 8%. So it means you need to be doing 12.5% just to break even with the market. Anybody who's generating 4 to 5% in excess of the market every year is a genius. There are very few investors that can do that, and that's just to get to break even with the market. The point of this is I'm trying to say it's not really a winnable game, and it's not a shock that most hedge funds close within a couple years because they're not even able to hit their benchmark. So if we go back to Buffett again, I know you're probably rolling your eyes. Over the last 20 years, I think he beat the market by under 3%. So if he was a 2 and 20 investor, his fund would have been shut down. If the best investor on earth can't make this math work, something needs to change. And I think that's part of the reason why you're seeing a lot of these funds shut down. So what I would implore to you is, if you're looking to get into this field, try and find somebody and work with somebody who has a lot of integrity, that treats their partners, their investors with a lot of respect, has a fair fee structure, and they're looking to go into inefficient spaces in the market. I think if you find that, or if you try and do that yourself, you'll be really successful. And with that, I'll open it up to questions and comments, and I'm happy to talk about other things that I might have missed.
Hey, Andrew. This is Alex. Thanks again for coming for UIC and for Skyping in for this talk. Really appreciate it. Thought it was a really good talk. One question I had was in your comments about I know it was an example, but about biotech, where you really have to understand something, and then there's kind of the percentages that get whittled down into a final product. My first impression of that was, I feel like implicitly in a lot of investments, you're making a bet on something being right or wrong, and you have to risk whatever you're doing and take in risk weighting and an expected value into consideration. So how do you kind of balance that kind of concept of where you're kind of always betting on something with the notion of sticking to simple things, and how do you kind of marry those ideas?
Yeah, I think I'm getting what you're I think if I didn't explain it, I might have not explained this well also. What I was trying to say is only 0.8% of all drugs get approved. And so even if you're looking at a biotech company, if you multiply anything by 0.8%, it's effectively zero. If you do a market analysis and you're like, oh, it's worth $100 million, multiply that by 0.8%, and it's a market cap that's really small. And very rarely are you going to be able to find companies that are, way cheaper than that. There's not a lot of upside. But if you hit it right and it ends up working, yeah, it's worth, $100 million or $2 billion. So that's kind of more what I was getting at on the biotech side. But the other piece, yes, you have to be thinking not in singular outcomes. You have to be thinking about, a lot of people think about it in three terms, a base case, an upside case, and a downside case. And then, you'll weight those. It's never one thing. It's never, only the base case that's the outcome. You have to weight the different outcomes and think about, what happens if I'm right? What happens if I'm wrong? Is there upside to my projections? Am I being conservative? And then, take all those things into consideration. I think the most important thing is look at that downside case and say, how much money am I going to lose, on absolute terms, if it happens? Am I comfortable with that? Am I okay with that? Because that does happen. And accept it when it does, and just accept that it's part of the process. But you want to be finding things, of course, that have asymmetric returns, not a lot of downside, a lot of upside, and really you only find that in inefficient spaces.
Thank you.
Hey, thanks for coming in and talking with us. My name is Max. I was just wondering how you think about idea sourcing.
Yeah, it's a really probably the question I get the most, and I imagine most people, not just me, get that question because there's no one way, and so I'm probably going to disappoint you with the answer. I was working with Vegeta this summer on a company that I came across by reading, just a random book. I was reading this book on material science, and it brought up, some novel materials that were interesting to me, and I was like, okay, well, I wonder if there's a company that did this, and that kind of got me interested. So it comes from a lot of ways. I'd say that investing is one of the most interdisciplinary sources or interdisciplinary efforts that you can do. So anywhere you look, you're always learning. Hopefully, you're always curious about how the world works. And you should be looking around and thinking about, well, who makes that, and who competes with that, and what does that mean for this? And I don't think that there's one place. But let me answer it in a different way. What I do is I often will go through and one thing I might do is I might screen for companies that have certain characteristics. Like if I'm trying to find companies that will deliver compound interest to me, I want to find compounding machines. The two are aligned. Things that will generate a lot of cash and then can take that cash and put it in new investments that'll generate even more cash and just kind of do that for me. And so what I'll do is maybe I'll make a screen for companies that have all those characteristics or not. And then I'll just start going one by one, going through the investor decks and their on their investor relations page. When something's interesting to me, but it's too expensive, I'll do something that I call putting it in the cupboard. So I have a watch list, you can use Google Finance, whatever it is, just of all those tickers that I was like, hey, that was interesting, but it's just too expensive. And all stocks, they have crazy volatility. That's why the stock market's so interesting. The 52-week high is usually versus 52-week low in a given year. It's usually like 80%. It's silly. No business really has its value changed that much in a single year, but you can use that to your advantage. And so when you have this long list of companies that intrigue you, that you think have great business models, and like you really want to be an owner of that business, you can come back to it. So that's one way I do it. I can't, some of the best investments that I'll give you an example. So when I was at Matrix, I spent a lot of time, as I said, I was selling short. And so one of the areas that I put a lot of time in was the semiconductor ecosystem that goes into smartphones. And the reason for that is I don't know how often you guys get phones, but I probably get one every couple of years. And so the market share changes between the different brands, and the technology changes really fast. And so bad technology gets ripped out real fast. And these semiconductor companies are really hard. And so I literally tore down phones and I said, okay, who makes every single component in here? Which of these components have these companies have the deepest moat, the deepest technology that differentiates it from its competition, which ones are more commodity. And then, there's this one company that came out of nowhere. I didn't know anything about it. I knew most companies, and it was called GT Advanced. Out of nowhere, it showed up. It was, I think it was like $1 or $2 stock, and it had ripped up to like $20. And what GT Advanced had done was they had partnered with Apple to, I don't know if anybody has like a nice watch. I mean, who has a watch anymore these days? But they would make sapphire crystal, which is like the hardest crystal on Earth besides diamond. And their plan was to put it on every smartphone, because we've all seen the spider web phones. And so that story, took off. And it just, I got so interested in it because it seemed like such a strange company. They had this weird deal with Apple where Apple didn't buy all this equipment from them. They gave GT Advanced all this debt to buy the equipment themselves, to make it for them. They put them in Apple's facility. They had all these crazy contracts where, Apple could buy from anyone. GT couldn't sell to anybody. GT didn't have control over the pricing. And frankly, the kicker was GT Advanced never made sapphire before, but it needed to make 20 times the entire market's volume of sapphire. And it's very hard to make sapphire. And so I got really interested in that one. And, we were short the stock for a bit. And frankly, the position probably would have been bigger had I had more time. But they filed for bankruptcy. In a single day, it went down 95%. This was a company worth $2 billion market cap that went to zero overnight. And, I wish there was some formula as how you can find that. Sometimes it's just going really deep into certain ecosystems, learning and being curious, and if you pay close attention enough, you'll find things that are interesting.
Hey, Andrew. Why do you prefer public markets over private markets?
Yeah, great question. So I was lucky. Here's a little background on my story, and I'll answer it in hopefully 30 seconds or so. When I graduated from Michigan, I wanted to go straight into investing. I didn't want to do investment banking, and it was a very tough time. I graduated in 2010, and I had 2008, 2009, 2010 in my in my career hunt. That was a very tough time to go into hedge funds. And my goal was I sent 100 resumes and one stock pitch, my resume and one stock pitch to 100 hedge fund analysts. And my hope was I'd get a job at one of them. So 100 resumes and ideas led to 20 responses, 10 callbacks, 2 in-person interviews, and no job offers. I was devastated. I thought I was going to be able to get, one job offer, but, one of the people that, I would, rip through annual reports with in the Tazi Center heard that I didn't get a job. And he was working at the one of the private equity groups in Goldman Sachs. and we had a mutual friend, and he asked if I wanted to help them find deals. And so I joined the private equity group at Goldman for, it was a very short period of time, a couple months. And fortunately, within 2 months of doing that, one of the funds I had interviewed with, they were like, "Hey, we're ready for you now." So I got to see the private market for just a little bit of time, and then I got to move to the public. So to answer your question, the biggest difference I've noticed is when you're a private investor, you are a deal taker. You're not a deal maker. You can't choose the companies that you get to invest in. They choose you. And so so what you do is you try and figure out, hey, what would I be somewhat interested in? Maybe it's investing in SaaS software companies. And so you'll email a whole bunch of SaaS software companies in the hope that, something interesting will come up. In the public market, I can choose to invest in any company at any time if I'm willing to pay the current price. So I think one's much more sales driven, much more deal driven, negotiating deal terms, getting to know every little thing. I think in the public market, it gives you a lot more flexibility. I'm just really curious. I'll learn. I can't, work on a deal for, 2 months and then have it fall through. I like to be in control. Maybe I'm a control freak. And then the last thing that I think is really important is you have a far less sophisticated seller in the public market. If you're buying shares from the CEO of a company, who do you think knows more about the business and what it's worth? I like buying from other public market investors because one of the hallmarks of what I do, I think that I do this well, is I do deep investigative research on companies. I didn't really get to talk about that, and maybe that's a topic another time, but I like to think that I invest with an edge. And so, when you have auction-driven prices where, like I said, the 52-week range for a business, it can be 100% in just a single year. But if you're talking with a private equity in a private equity deal, the management team, the valuation maybe only changes 10% in a given year. If you're like, hey, what about now? Do you want to sell now? So I think there's a lot more price discovery and an opportunity to find differentiated prices in the public market, but you might be able to find more off the beaten path ideas that others haven't seen in private equity. So there's puts and takes. It's good. There's good things and bad things. Public equity has, short-termism, people worried about quarterly results, stock prices. That's all nonsense. So there's good and bad on both. Anyone else?
Okay, I'll go for it. So,
No, go ahead. You got it.
oh no, Anthony, you should ask. I'm working it.
So you just talked. Can you see me?
Yeah.
Okay. You just talked about deep investigation of companies, and that gives you an edge. I'm wondering, what do you feel separates you from other investors as far as investigation? If you're willing to share that.
Yeah, of course. It's funny because if you told me that I couldn't be an investor, if you said, Andrew, you're not allowed to be an investor for some reason, and you had to do something else, I would probably tell you that I'd want to be, a detective. I'd want to be an investigative journalist if I could write. I'd want to be a lawyer who's trying to figure out the truth. I always got excited by those things. And frankly, this job is a lot like what I do is a lot like being an investigative journalist. So what is it that I do that's different? I think if you talk to any investor, everyone will say that they do deep research on companies. That's just the fact. Everyone thinks that they do the best, most complete research. Every soldier thinks their boots are the shiniest. But I'll tell you, and I don't know how to say this without sounding like a jerk, I haven't found a lot of people who will go into a management meeting, if it's a group meeting, and they'll know as much as I do. And, that sounds really arrogant, but I have a cohort of other investors who do the type of work that I do. It's a very small universe. And the biggest reason is when you have, let's say you have 50 stocks in your portfolio, you just don't have time. I can spend a year investigating a single company because I haven't mentioned this, but I'm willing to take very, very, very concentrated positions, like 5 investments. That might be enough for me, like in my portfolio. So what do I do that's different? I try and do everything I try and be incredibly comprehensive. So I go, let's say if I'm looking at a certain company, I will look at all the court filings for that company. Has there been any safety violations, OSHA violations? Management teams, do they have prior criminal records? Did they graduate from the schools that they said they graduated from? If I went to their church, which I've done before, what does their congregation say about these people? I talked to all the former employees who left. What do they have to say about these people? I talked to their customers. I talked to their competitors. This is the type of work, I read everything. I read all the annual reports. I try and see what's changed. Like, what is the little language that's changed? What are they hiding? There's no one formula. I try and find, unique sources of data that might be hiding on the web. And let me tell you another story. So there was a company that we had shorted called Taro Pharmaceuticals, and Taro is a generic. You might know Taro. There's a generic. It's a generic company that sells drugs in topical ointments, and I found Taro to be perplexing because they had no volume growth, but I think their profitability went up like 8x in the last like 5 years. And I was wondering why. And I found this amazing database on the web called NADAC, NADAC, which shows drug pricing data. And it's really hard to get at the data. It's there and you can download it, but it's really it's not formatted well. It's not easy what the takeaways are. And I took all that data. I did a time series data for every single active ingredient. I figured out which ones were Taro's, what was the weighting of Taro's portfolio, and I could actually see what their price increases were. And I realized that they were gouging their customers, and it was clear that that doesn't happen very often. You can't raise the price of every one of your drugs like 20x if you're a generic. Like, you're a generic drug. And I realized that there was something really strange going on at Taro. And what had happened shortly after was they got subpoenaed by the DOJ for colluding with their competitors. Everyone was raising prices in lockstep. Those were the types of their payers, the people who are paying them, they were fighting back. They realized that this was happening. And I was talking to those people too. This is the type of stuff that I don't think the average person will do. Here, I'll give you another example. There was a company called Himax that we also shorted. Himax, they make semiconductor chips, but do you remember like Google Glass or the Microsoft HoloLens? Remember those? So they made it's good technology that they made the optics, like the glass that you could both look through and the screen would be projected on, so you had augmented reality. And Himax had told the market that they were going to do 1 million units and they were going to make $150 per unit. Now this company had like 400 million of revenue, and so to go from 0 to 150 million of incremental revenue in another business is huge growth. And the stock went up like 4x or whatever it was, 3x. And not a lot of people do this, but I bought one of those things. I bought the Microsoft HoloLens and I signed up for it. And the amazing thing was I was ready to buy it. It was thousands of dollars. I didn't even have to put any money down. And they told me what my wait in line was to get it. I was number 20,000. It was already like October of that year. I knew that right then and there that they didn't sell 1 million units and they were totally lying. And lo and behold, at the end of the year, they missed the revenue number by 20%. The revenue number by 20%. So if you do some of the funky things, there's a lot of advantage to doing that and going where others aren't willing to go. So that's what I call investigative. You may not call that investigative, but hopefully that answers.
Yeah. We have time for like one more question. Yeah.
Thank you for talking to us. I was wondering, you said at the beginning of your talk that you're not really a company, it's kind of just you. So I want what do you do? Like, who do you work with? Like, what's your company like?
Can you just ask the question again? I kind of missed the beginning.
Yeah, I said at the beginning of like kind of your talk, you talked about how like you're not really a company and you're more so like just you. And I want you to like elaborate upon that and like what your company does and like what your day-to-day is like.
Yeah, totally. So one of the things I learned about investing, it's not a great team sport. And I don't know if you know this about, most hedge funds when they go out and they market themselves and they try and raise money, they'll talk about how great the team environment is, and how they have a culture of collaboration, and someone will do all this research and then they all talk about it together and they come up with all these great decisions. I've actually learned that a lot of the best decision making in this field comes from being independent. And, some of the best investors I can think of are single man operations. They don't have a team of analysts running around. And so I decided I needed to go my own way if I wanted to invest in the way that I thought was right. I literally couldn't find the fund that I wanted to invest in or work for. So I figured I needed to make it myself. So what I do right now, Bonsai Partners, it is a small investment fund. I have a small group of investors right now. I launched, literally this past month. I'd been working on building it out, doing all the structural work over the first, 6 to 9 months. And, we're investing in the public equity markets. Not we, I am investing in the public equity markets. Very concentrated portfolio, like I said, 5 to 15 companies in the public space. I'll short only opportunistically if I think it's a slam dunk. It's almost all long equities. And, the thing that's different is, kind of what I talked about. I go where others aren't willing to go, and I do what others aren't willing to do. I seek those inefficient parts of the public equity markets that people can't access or don't even know how to access. I like to call them, barriers to investment. We think of barriers to entry in a business. I think there are barriers to investment too, which can cause really inefficient markets to happen. So some of those barriers to investment that I look for these companies. One of them is I look for unprofitable businesses. How do you value a business that doesn't make any money? If I told you I want you to buy a lemonade stand and you talk to the owner and they said we lost $1,000 every year, what would you pay to buy it if I said I wanted you to buy it, if you were my analyst? You probably scratch your head and say, I'm not really sure. And there's a lot of price discovery in those opportunities. If you can find the thing that's not profitable today, but will be profitable later, it can be a great investment. Other things I look for technical companies that you need to do, a lot of deep work, not a complex system, but, it takes a lot of time to figure out what they do. I look for small, illiquid companies, not a lot of analyst coverage, maybe even has some, near-term headwinds, and so people confuse uncertainty for risk. So those are the types of things that I look at. I'm solely focused on public markets, but, I poke around in other places too. Hopefully that answers your question.
All right. Well, thanks so much, Andrew. Can we just get a round of applause? I think that's a really good talk.
Before I sign off, I'm happy to help. Like I said, I used to be an MII, and so if anybody has any follow up, my email is Andrew@Bonsai Partners, BONSAI partners.com. So hopefully this was helpful, and it's great to talk to you all. Hey, guys.
It's really nice to see you again.
Yeah, likewise. Take care.
Thanks, Andrew.
Bye, guys.